Are you looking to generate money off of your money? Well, take a listen today as we discuss how Lynx Equity Income Trust can certainly change your perspective on your income portfolio. Take a listen. Hey, welcome back to Money Match. I'm Ian Ardill. Today, I am with Michael Denny, who is the Managing Director of Lynx Equity Income Trust. Michael, thanks so much for joining us today.
Pleasure, Ian. Pleasure.
Michael, you and I have known each other for the last 6+ years. It's a pleasure to have you on the show here today.
Thanks.
Michael, just for those of us who are just listening in for the first time,
Sure.
Just give us a snapshot really quickly. What's the elevator pitch, or what's kind of the real basic understanding of Lynx Equity Income Trust?
Well, Lynx Equity Income Trust is a holding company. We buy small businesses, medium-sized businesses from retiring owners. We've been doing it for 15 years. We currently own 14 businesses in the States, generating somewhere in the area of $450 million a year in income. We're one of Canada's largest corporations, scoring, I think, 478 on the Financial Post 500.
Okay.
And we got there in 16 years, which is a tremendous compliment on the strength of our business model. As you know, Ian, we buy companies from owners that want to retire, that have a situation where they can't transfer ownership to their children or their family because nobody wants to run the business. They have a problem. So we step in, we buy the business at a fair price, and then we operate it. Our intentions are to buy these businesses that have been in business for 20 years plus and keep them for another 20 or 30 years.
So let's just talk about that business model there for a moment. I think for many of us who are listening to this call are business owners. And one of the things that oftentimes when somebody comes in and buys the company, oftentimes in the world of mergers and acquisitions, they're doing one of two things. One, they're either trying to rapidly grow that company because and so they try to rapidly scale it, either successfully or unsuccessfully, or they go in to liquidate it. It's more of like a vulture type mentality where they go in and they take out their competition, or they rip it out apart for scrap metal. Is that a true statement?
Yeah, that's the traditional private equity model.
So how are you different?
Of flipping it in 5 to 7 years. We aren't private equity. We are a holding company. So when we buy a company from a retiring owner, our intention is to keep all the staff that are working there in place, keep the owner's name, the former owner's name on the building, respect his relationships in his community and the things he's built over the last 20 or 30 years. And our instructions really to the new president who takes over from the retiring owner, our instructions to that new president are, look, this business runs well, it's profitable, just keep on doing what it's been doing. We're not looking to re-engineer the company or change it in any dramatic way. We're not trying to merge it into a larger entity. Company's being successful, we just want it to stay successful.
And I think one of the things that I think is really neat is you also have a really unique way of de-risking your investment when you buy it. If you're buying a new acquisition today, and let's say you're buying it at a 3 or 4 times multiple, are you going to pay all of that up front, or how does that work?
Well, we usually, every deal is a little bit different.
Okay.
But you know, the sort of the generic model is we sit down with the selling owner, we negotiate usually to pay him half of the price on closing, and then the other half we pay out over 3, 4, or 5 years. And that's his transition period. So he stays involved in the business for 3 to 5 years to help the new president learn the business and take over the business. And sometimes that second piece is a vendor take-back note. But often in this environment, it's not even a vendor take-back note. What it is an earnout. So what we do is we tell the retiring owner we'll pay him 25 or 30% of the profits from the business for the next 5 years as his second part of the payment. So it is definitely a de-risk situation. I always like to say, what makes a great investment is not buying into a great company. What makes a great investment is paying a great price, and certainly structuring it properly is paying a great
Wow,
price.
I love that statement.
Mm.
So say it one more time. What
Yeah,
makes
what
a
makes
great
a great
investment?
investment? I mean, people think, oh, well, I gotta buy Google or I gotta buy Apple. Those are great investments. Well, you know what? If you pay the wrong price, even a great company can be a terrible investment. So I think, and this is the Warren Buffett story. I mean, the secret is not buying into a great company. The secret is paying a great price. That's what makes a great investment.
Yeah. Yeah. I love that statement. So you are looking and shopping for good quality companies at great prices.
Absolutely, absolutely. Now
And-
we're not trying to do anything untoward. We're paying a fair price for these
yeah,
businesses.
absolutely.
But the difference is, if you're an owner and you're 70 years old, you want to retire, and you've got $10 million a year in profit, right?
Yeah.
Well, you've got no problem selling your business. You've got people flying in from New York and Boston and Montreal and Toronto trying to buy your business. It's an auction, right?
Yeah.
You say, have my business for sale, and you get all kinds of bids for it if you've got $10 million in profit. But if you're a small business with 1, 2, or maybe even $3 million in profit, nobody cares. Nobody cares. I mean,
Yeah.
the big money guys who are running billion-dollar funds, they look at your business, they go, it's too small, we're not interested. They don't come to buy it.
And correct me if I'm wrong, Lynx has really created themselves as a unique investor in the sense that you oftentimes specialize in being the only buyer at the table. Fair?
I think, to the best of my knowledge, we have always been the only buyer. We have so many acquisition opportunities that if someone approaches us and says, my business is for sale, it's an auction, we're accepting bids on, July 31st. Our immediate response is, thank you very much, but that's not what we do. We're not interested in competitive auction.
Yeah.
Good luck with your auction. If it works out for you, great. If it doesn't, call us back and we'll enter into a conversation with you.
So let's change gears here a little bit.
Sure.
Let's drive in. You've talked a little bit about your business.
Yeah.
I just wanted to maybe just articulate over the last, number of years, it's been a wild ride in the economy. We can talk about COVID, rising interest rates, a looming recession. I know I just swore I used the R word, but yeah, all of those things. I'm wondering, how has Lynx Equity really kind of survived through that storm? Did you guys close down your doors during COVID, or what did that look like for you guys?
We had a couple of setbacks. We had a couple of our businesses that were retail focused. We own a wholesaler of jewelry, religious jewelry products, and we own a kitchenware store in Portland. And those we own a flooring company in San Francisco. And because of COVID, those companies actually had to shut their doors for a few months. But one of the advantages that we have is, because we have a portfolio of 14 companies, the companies that had to slow down their operations or shut their doors because of COVID were offset by actually better performance in a couple of our other companies. We didn't know this or expect it, but surprisingly, what happened is a number of our companies are flooring contractors. And they go in at night to put in new floors in office buildings and restaurants and do retail stores, retrofit, right, to do repair work. And in COVID, the buildings were shut down. So all of a sudden, we found out a lot of our people could go into buildings during the day to do the contracting work. And we were actually able to accelerate a number of the contracts we had at our flooring contractors. So we found that our profitability on that side of the business went up during COVID, while our retail-oriented things went down because of
and so correct me if I'm wrong. I don't want to misrepresent things here, but ultimately, at the end of the day, you actually were very profitable throughout.
Oh yeah. Well, there was no issues there at all. We had a slight revenue fall off, but profitability was fine. And the other thing, if you really dig into our business, you have to know that we are highly cash flow positive. And we use that cash flow every year to buy more companies. Well, during COVID, we stopped buying companies because it was, the economic situation was questionable. So we stopped buying companies. Well, when we stopped buying companies, all of a sudden we had cash flow that we didn't have a use for, so we just put it on our balance sheet.
Got it.
We worked hard. The thing that fussed us the most or upset us the most is that we had in a couple of situations had to lay people off. And that's always very upsetting because we pride ourselves on our loyalty to our staff. So that was the hardest part. Financially, we did fine.
I think as we look forward to, some rocky waters ahead, again, I wish I had a crystal ball and could tell everyone what's going to happen. But I think one of the advantages of one of the things I love about the Lynx story is that truly that you are diversified, that you do own a really, crazy amount of diversity in your portfolio. And so if a down market or a recession market hits some of your, companies, other companies are going to find traction and success in that environment. Is that a fair assumption?
Yeah. Some businesses will do poorly and some businesses will do fine. It just depends on, the individual business, and it depends on what region they're located in and how bad the economy is. But the other thing to think about also is we're conscious of recession risk, right? That's always on our mind. And so we have historically avoided a number of sectors. Like you will not find any restaurant. We don't own any restaurants because restaurants are they're a wonderful business when the economy is strong, but restaurants in a recession, horrible, because that's the first thing people cut as they stop going out for dinner, right? So no restaurants in our portfolio. Another sector we avoid is anything that's commodity related. So mining, oil and gas, those kind of things, when the economy is great, highly profitable. But when things go bad, they lose money. So we are not interested in volatility. We're interested in very, old economy, low tech, boring businesses that just make money every year. Little less during a recession, a little more when the economy is strong. And the other thing to think about also is that because our businesses are relatively small, we're not buying businesses that compete on a national or international basis. So you've certainly read in the papers recently of all the logistics problems with companies trying to get parts and supplies from China or Europe, and everything. The ports are all jammed up, and that's hurting those businesses. Generally, that doesn't affect us because, again, we're not buying companies that compete on a national or international basis. We generally are buying companies that are competing locally. For example, one of our most profitable businesses is one of the leading flooring contractors in Omaha, Nebraska. So we don't have to worry about what's happening in New York or, Europe or anything. They are focused on the Nebraska economy, and that's where they've had success historically, and that's where they're going to have success in the future.
So, Michael, let's change gears off of the underlying security, because what we've had a conversation about up till now is the underlying security that backs up and funds the investment where investors are invited to participate in. Mm-hmm. And so the investment that investors are invited to participate in is the Lynx Equity Income Trust. Right. And ultimately, this is these kind of very unique royalty shares. And I'm wondering if you can describe to us how those work and how are they positioned in the capital stack?
Right. So what happens is that you as an investor come into the Lynx Equity Income Trust. The Lynx Equity Income Trust then takes that money and lends it to the U.S. subsidiary of Lynx Equity. And then that U.S. subsidiary uses your money to buy more companies. And initially, that U.S. subsidiary pays the money back to the income trust at a fixed rate. But as the U.S. subsidiary grows in organic revenue, then that U.S. subsidiary will pay a little bit more to the trust. And we pass the majority of that increase to the investors.
Hence the royalty piece.
That's the royalty explanation. So when you invest in the trust today, you'll receive an initial payment quarterly that equals 8.25% on your money per year. Now, over time, at least a year from now, we'll reevaluate that rate. And if our US subsidiary has had growth, then we'll pay you a slightly higher rate. And if we do pay you a slightly higher rate, that rate will stack on top of any previous year's increases. So
Yes.
I'm sure you can share this information on paper with your clients or potential clients. But our oldest investors now are making about 9.5%. These are people that invested with us in 2016. People that invested with us in 2018 or so, they're making about 8.6%. And then our newest investors are making 8.25%. So I tell people that, look, 8.25% is a fantastic return. Make your decision based on 8.25% versus other alternatives you may have. And if our business grows, we'll pay you more than 8.25%, but don't count on that. That's a bonus that would be great to receive. But make your decision based on the 8.25%.
Fantastic. I think, you know, the income that's generated from a cash on cash yield is a very attractive story. But I think where I get really excited is around the conversation of risk and reward, because the reward is nice, but I would argue that there might be other alternatives that are more quote unquote potentially rewarding. But the risk that I think is associated with this investment or lack thereof is very attractive, or the way I would argue that you're managing the risk to the investor is very attractive. So I'm wondering if you can describe for me what would happen with a traditional debt fund if they dropped, say, 20 or 30% versus the style of investment that we have with you.
Yeah, so we're not a fund, we're a corporation. And as a corporation, we have owners, equity owners, that have substantial wealth invested in our company. And if you ever have a setback in our business, it's the equity owners that take the financial hit before any debt holder, any royalty holder would take a financial hit. So to use an example is if you had a traditional debt fund, you normally have the debt fund here, and then you have a manager off to the side who manages the fund and then takes a fee from the assets in the fund. If the fund makes a bad investment and say they have to write $10 million off or whatever number is, then the NAV of the fund goes down by $10 million. The manager doesn't have a financial hit because they don't have any equity invested in the fund. They're providing a service and managing the fund. We are not like that. We are different in the sense that we're a corporation and we have an equity in our corporation. We have bank debt in our corporation, and we have the trust debt in our corporation. So if you think of us as having my numbers are about 70% equity, about 10% trust debt, and about 20% bank debt. So if we ever had a setback, say we bought a company, it goes bankrupt, say we bought two companies, they both went bankrupt, what would happen is the equity owners would take the financial hit and the bank and the trust would be unaffected. And that's dramatically different, of course, as a traditional outside managed debt fund.
So what you're telling me is the risk that we're consuming in order to participate in that 8.25 is mitigated by significant protection. To the tune of approximate numbers of about 70%.
Yeah, back of the envelope, sure. Now, the thing you must remember is that, you know, normally if a guy was pitching you on investing in his corporation and paying you 8.25%, you would look at that askance because it would be generally relatively high risk, because it would be a company in one business and therefore it's risky, right? And you might be attracted to a debt fund because a debt fund would have, you know, 20 or 30 different investments in different industries, right? But we're different in the sense that we're a corporation, but we own 14 businesses in the States in different regions of different sizes with different management teams. So while we have the protection of equity like a corporation, we also have the diversification that you'd find in a debt fund. So we find that, well, at least our opinion is, we are on a risk-adjusted basis, our return is quite attractive.
Well, Michael, I couldn't agree more. Again, that is not a suitability statement for any individual, but rather just exciting to hear how, investors get the opportunity to participate with you. I'll end with this question, Michael, really quickly. Why Lynx? Why should somebody trust you with their money?
Well, we've been doing this for 15 years. 16 years now. And over 16 years, we've raised hundreds of millions of dollars from individual investors, from institutional investors. And we've never missed a distribution, and we've never missed a request to redeem units. And so I think that's a track record that speaks for itself.
Wow. Thanks so much, Michael. For more information, you can check out the show notes and also give me a ring or check out us at ardillgroup.com. For next time on Money Match, thanks for joining. Bye-bye.
Always a pleasure, Ian. Bye-bye.
Bye-bye.